Hey everyone, and welcome. So today, we're going to dive into something pretty wild, a financial secret weapon that lets one of the biggest companies on the planet basically thrive on a number that would scream bankruptcy for almost anyone else. Seriously, it's a paradox that just flips business logic completely on its head.
Just think about that for a second. What if a metric that every single business textbook warns you about, a huge flashing red light for disaster, was actually the secret sauce? The very engine driving a multi-billion-dollar empire. Well, believe it or not, that's exactly what we're going to break down today. All right, so if you've ever taken a business or accounting class, you've probably heard of working capital. And the rule they drill into is super simple. If that number goes negative, you are in deep trouble. But what if for some companies, the rules just don't apply?
I mean, look at this. The difference is just night and day. On one hand, you've got the textbook definition. Negative working capital means you literally don't have enough cash on hand to pay your short-term bills. It's the classic sign a business is circling the drain. But then, you look at a behemoth like Amazon. Their working capital is negative all the time. So, are they on the verge of bankruptcy? No way! In fact, it's the absolute secret to their incredible, explosive growth. So, the big question is, how? How is that even possible? How can being, for all intents and purposes, in the red on paper, make you one of the most powerful companies on the entire planet? Well, it all comes down to mastering the flow of cash. And to really get it, let's start with a super simple example. Okay, let's say you and I decide to open a lemonade stand. What's the first thing we have to do? We have to go out and spend our own money, right? Maybe $100 on lemons, sugar, cups. That cash is gone from our pockets before we've sold a single drop of lemonade. Then we make it, we sell it, and finally we get paid, say $150. See how that works? Our money was tied up in inventory. We had to spend money to make money. This is how 99% of businesses operate. All right, now let's flip that on its head and look at how Amazon does it. Think about the last time you bought something on Amazon. Let's say it was a keyboard. You click buy and bam, your credit card is charged instantly. Amazon has your cash on day zero. But here's the crazy part, the real magic trick. Amazon doesn't actually pay the company that made that keyboard for, well, maybe 30, 60, or even 90 days. Think about that. For up to 3 months, Amazon is just sitting on your money, using it before they have to pay their own bills. It's a total, complete reversal of how a normal business works. So this brilliant flip of the cash flow, it's not just some clever party trick. It's actually something you can measure with a specific formula. And this formula, well, it's like the secret code to unlocking how Amazon's financial engine really works. It's called the Cash Conversion Cycle, or CCC for short. And all it really means is it's a measure of how many days a company's cash is tied up while it's doing business. For most companies, the goal is to get that number as low as possible, right? You want your cash back fast. But for Amazon, the goal is to make it go negative. Let's put some numbers to this so it makes sense. So a typical retailer, let's say they hold onto their inventory for about 60 days before it sells. Then maybe they wait another 30 days for customers to pay their invoices. And they usually pay their own suppliers in about 30 days. So you add the 60 and the 30, then subtract the 30 they pay out, and you get a cash conversion cycle of 60 days. That means for 2 full months, their cash is just locked up. Now, let's look at Amazon. They move products so fast. Maybe inventory only sits for 30 days. They get paid instantly, so that's 0 days. And here's the kicker. Because they're Amazon, they can tell their suppliers they'll pay them in 90 days. So you take 30, add 0, and then subtract 90, and what do you get? A negative number. That's right, negative 60 days. This is the whole ballgame right here. What this means is that for every single thing Amazon sells, it essentially gets a 60-day completely interest-free loan from its suppliers. So instead of needing cash to run the business itself becomes a machine that just generates a giant ever-growing pile of free cash.
So what do you do when you have a constant, never-ending river of free money flowing into your company? Well, if you're Amazon, you use it to try and take over the world.
And we're not talking about small potatoes here. When you're pulling in over $500 billion a year in revenue, a negative cash cycle isn't just a neat little trick. It is an absolute financial superpower. What this creates is basically a continuous, rolling loan from all its suppliers. And at any given moment, that loan is worth tens of billions of dollars. This is cash that Amazon never has to go to a bank for, and they never have to pay a single penny of interest on it.
It's completely free money. So, where does all this free cash go? Well, Amazon plows every last bit of it right back into growing the beast. They use it to build those gigantic warehouses you see everywhere, to fund R&D for things like Alexa, and to pour billions and billions into their cash cow, Amazon Web Services. They are literally, and this is the key, funding the growth of their entire empire using other people's money. Okay, so this all sounds amazing, right? Like some kind of infinite money machine. But, and this is a huge but, this strategy is a total double-edged sword. It's unbelievably powerful, yes, but it's also incredibly dangerous if things start to go wrong. Now, this next part might sound a little intense, but there's a kernel of truth to it. The entire system hinges on one thing: using new cash from today's customers to pay off old debts to suppliers from months ago. And a system built like that, well, it can only work if everything goes perfectly. There are basically two non-negotiable, ironclad rules for this to work. Rule number one, you have to keep growing. No exceptions. The money coming in from today's sales is what's paying for the stuff you sold 3 months ago. If that growth ever stops, that river of new cash dries up. And rule number two, you have to be the biggest player in the room. You need absolute market dominance. Only a company as massive as Amazon can walk up to its suppliers and say, hey, we're going to pay you in 90 days. Take it or leave it. Any small business that tried that would be laughed out of the room. And what happens if you break those rules? What happens if growth suddenly stalls, even for a little bit? Well, the new cash stops flowing in, but those huge bills from 90 days ago, they're still due. All at once. The company is hit with a massive, sudden cash shortage, what they call a liquidity crisis. And this, right here, is why you sometimes see big retailers that seem to be growing like crazy suddenly go bankrupt during a recession. Their growth engine sputters, and the whole house of cards comes tumbling down. You know, this quote just nails it perfectly. Thinking of negative working capital as a crown, it's a symbol of incredible power and efficiency for sure, but it's also unbelievably heavy, and only the absolute strongest companies can wear it without being crushed by its weight. So is it a weakness or a weapon? The answer really is in the cycle. The next time you're looking at a company and you see it has negative working capital, don't just jump to conclusions. It could be a 5-alarm fire, or it could be the mark of an absolute titan like Amazon. The real story isn't just in that single number. It's about understanding the power and the momentum that's driving that entire cycle. Thanks so much for tuning in.